So welcome everybody. I appreciate you all taking your time out on a Tuesday evening to sit down with Chris and I and talk about some proactive year-end tax planning ideas for the year, this year, and any year. So a little bit about me. I've been doing this for a little over 25 years. I'm a CPA. I have my MBA from the University of Maryland. I also am a fully licensed financial advisor. I work with Chris, partner with Chris. So I've been focusing on small businesses, day traders, and the wealth management process with my clients. So this is a good partnership with Chris and I.
So I, like Dave, have a lot of experience having been a financial planner, a certified financial planner for well over 26 years now. And I have an individual practice. And as Dave said, he and I do a lot of collaboration together. We have a lot of mutual clients trying to marry the intersection of financial planning, wealth building, and investment management with excellent tax planning, and so we work very well together. We wanted to put this presentation together tonight because so much has happened this year, including recent legislation, and so we think you're going to enjoy the information we're going to communicate to you tonight.
One of the things I'll just repeat, we have everybody on mute, so if you do have any questions, please put them in the chat, and if it makes sense, I'll answer them in live. Otherwise, I'll try and answer them at the end of the presentation. So part of what I like to do in my practice, I was just talking to Chris before we started, is I've started to reach out to my small business clients and some of my individual clients to talk about being proactive before the end of the year. Chris just mentioned that there's been a lot of changes this year. The world has gone through a number of changes. We still are. So I like to be proactive in the way that I manage my practice and my clients as opposed to reactive. So that's what I'm trying to help you guys with tonight. So let's go. So we're going to talk about a little year-end tax planning, and then we're going to talk about some ideas and strategies that we could do now before the end of the year. And then at the end, like I said, we'll have some questions and answers, and if you have anything along the way. Now, most importantly, like I said, it's been a rough year for some of us, mentally, health-wise, everything. So please stay healthy. Your first wealth is health. I feel that way. Chris feels that way. My clients are important to me. We're not here just to maintain your economic health and financial health, but if there's anything that we could do, that would be great. So there's 5 main areas of financial planning that you could work with. The 5 of them are preservation planning, retirement planning, tax planning, estate planning, and investment planning. Tonight we're going to focus mainly on tax planning and the ideas that you can have associated with that, and some of the laws and changes that have occurred over the past couple of years, and some ideas that you could potentially implement before the end of the year to maximize your tax savings and or a number of other things associated with your tax returns. So a couple of the big things that have happened over the past year. The Secure Act was passed last year. Chris will talk about that a little later. The CARES Act, which is, we've all heard about the PPP funds and all the unemployment benefits and such that people have received this year as it relates to the pandemic. And then most recently, the presidential election. We'll talk about some potential changes that President-elect Biden has talked about during his campaign. So we're talking here about tax planning versus tax preparation. What's the difference, right? The main difference is what we're talking about tonight is planning. We're planning to make appropriate changes and decisions today in real time as opposed to tax preparation. Everything's happened, the year has ended, you've received all your forms, and we're going to prepare your taxes. There's very little that you could do after December 31st. So we could be proactive and plan now. Benjamin Franklin, I'm a big fan of some of his quotes. By failing to prepare, you are preparing to fail, right? So let's be proactive. So when we start talking about taxes and planning, with the tax law changes of 2018, they have changed the tax rates. There's now 7 rates, 10, 12, 22, 24, 32, 35, and 37% plus. I put a plus in there because there are certain expenses and deductions that begin to phase out the more income that you earn. So you actually can be paying more than 37% as a marginal rate as you earn more and more over time. So if you look at the little pyramid down below, that shows what the brackets are, and those are in place until January 1st, 2026. That's what the Tax Cuts and Jobs Act of 2018 set forth. It's a set to sunset as of the end of 2025. So when we look at it in the current situation right now, you can see what the changes are versus what they were. That first column is where things were before 2018. You could see that in general, the married person and the single person, and I could definitely tell you that virtually probably 99.9% of my clients paid less in taxes over the last 2 years, 2018 and 2019, than they would have with the same income in previous years. So we have to try and take advantage of the tax brackets where they are right now versus where they are headed in 2026. Or back to 2020.
So Dave, in your opinion, I think, if I could just jump in for a second, that what's been underreported and not talked about enough with the Tax Act is people talk about the reduction in rates, but I think almost as important is that the brackets have expanded. So at those lower rates are available at higher incomes than before, and in certain instances it opens up some good planning opportunities. We're going to talk about like Roth IRAs in a few slides. Are you surprised that it's not talked about more, this larger brackets at lower rates, helping people out reduce their taxes?
Well, I think the biggest, yes, when I talk about it with any of my peers, I'm surprised it's not talked about as much. But for the average person, it's like somebody asking me how to build a house. I know what it looks like. I know how it should be made, but how to actually do it, I don't know. So that's generally the conversation I have with most of my clients. So their understanding of it is me telling them that their tax is a little lower. But, I mean, the proof is in the pudding. When you look at this picture, look at how much lower the rates are versus where they were. And the much bigger, the wider bands, like especially the 24% bracket and 22% bracket for married individuals. I mean, if you look at it, there's a very narrow band of 32% that used to be at the high end of 33%, and the 33% bracket would be in the middle of the 24% bracket for married. There's a much thicker band at the 35% bracket for singles, but
right.
we used to get, single people used to get to the highest rate very, very, very quickly. So the fact that they actually almost mirror the married brackets at the higher end of the earners is a big, big change for single earners. So one of the things we're going to talk about a little bit as we go along is the standard deduction. Standard deductions changed significantly a couple years ago. It was a pretty low fence to jump over in order to itemize your taxes. But with the 2018 tax changes, we did away with personal exemptions, and those personal exemptions essentially were baked into your standard deductions. So those fences are much, much higher to jump over in the current years as we have this short-term change in tax law until 2025. So the standard deductions for single are $12,400. They used to be a little over $6,000. The married filing jointly are $12,800. They used to be almost $13,000. The head of household is $18,000. They used to be about $9,000, and married filing separately used to be about $6,000. So they're a big, big change. And part of the reason that this change was made was so that most people got the benefit of a higher deduction, and the amount of people that itemize versus 2017 dropped precipitously. They expected, and the numbers actually played out, that almost 94% of people will take the standard deduction in the new tax law change.
So, Dave, do you find in meeting with your clients that that means that for a lot of people, they're no longer deducting their mortgage interest on their primary residence like they used to because they're doing the standard deduction now? Is that something that's overlooked too, you think?
I think the biggest change for the individual in terms of itemizing isn't mortgage interest, it's the limitation on state and local taxes, which we'll talk about in a couple slides. But the biggest thing to look at in terms of your itemized deductions, in the past we used to say try deductions when you can. Accelerate your deductions into the current year because a dollar today is worth more than a dollar tomorrow. The biggest change I've had in my conversations with clients is to time or plan your deductions as opposed to just look at them as quickly as possible. And we'll talk about through an example what I mean by that in the next couple slides as well. So we talked about this. Chris brought it up. Mortgage interest in your state and local taxes are by far your largest deductions for most people. The change that was made in 2018 is you're limited to interest on your primary home or all homes up to $750,000 of borrowed funds, and if you're married filing separately, up to $375,000 of borrowed funds. The biggest change in 2018 was made in state and local taxes, and this is what affected most people, although I'll talk about it in a minute. It probably didn't. And what I mean by that is the limitation on state and local taxes is 10,000 people for single and married filing jointly filers, 5,000 for married filing separately. So I have clients in New York that pay house taxes of $32,000 annually, but they're limited to $10,000 a year as a deduction. So they came to me and said, what should I do? Should I try and pay my taxes in advance before the law went into effect? And what happened to most people in the prior tax law is they got stuck in what was called alternative minimum tax. And believe it or not, even though you got limited by your deduction, SALT and local tax, or your state and local taxes, by essentially eliminating the alternative minimum tax, most people still paid less, even though their deductions were, in some cases, precipitously less than they were in previous years. So here's one of those examples that I was talking about in timing your deductions. So one of the things that you could definitely plan and take advantage of over time, when my mom was alive, I used to plan her real estate taxes so she would pay 5 payments one year and 3 the next, so she could take the standard deduction one year and itemize the next. Well, now you could do the same thing with this much higher standard deduction. Let's just say that we wanted to make a contribution to any charity, right? And we wanted to make a charitable donation of $10,000 a year. But we had mortgage interest of $5,000 a year, and our state and local taxes we maxed out at $10,000 a year. So if we made $10,000 contribution each year for the next 3 years, Well, our standard deduction for a married filing jointly right now is $24,400. If we have $10,000 of state and local taxes plus $5,000 of mortgage interest and then a $10,000 charitable donation, that puts us at $25,000. Well, that's great. We could itemize, but we're only have an additional $600 of deduction versus the standard deduction. Versus if we bunch that charitable donation like we do in the right-hand side of this analysis, 1 year we take a $30,000 charitable donation, and then we take the standard deduction the next 2 years, and just by looking at this, we could save almost $7,000 by giving that charitable donation this year and then taking the standard deduction next year. This is huge if you're thinking about, there's a lot of people that make the same donation year in and year out, and they're really close to itemizing one way or the other. Either they can't itemize or they're not itemizing. So what I've told my clients to do over the past couple of years is exactly this. Why don't you take that charitable donation, if you make it near the end of the year, just save it, make it in January, and then make your next donation in December, so you essentially are at least doubling up to benefit, and then you skip a year.
That's a great tax savings strategy. We wanted to talk to you about qualified charitable distributions, or QCDs. They're a great strategy for retirement savers. So first off, know that the required minimum distributions used to be, for the longest time, began at 70.5. When you got to age 70.5, the IRS required you to take a minimum distribution from your pre-tax retirement accounts. In the Secure Act, which was passed in December of 2019, this change occurred, moving the day from 70.5 to 72. Now, I think, Dave, you would agree that the Secure Act would have gotten way more attention this year from a planning perspective, if not for all the changes resulting from the pandemic. But the QCDs are still allowed at 70.5. So what you're allowed to do is, if you have a pre-tax IRA, a pre-tax retirement account, you could take money out of that retirement account and give it to charity, and you will not pay taxes on it. It's the way that you could take money out of your retirement account and avoid paying taxes and get the money to the charity or charities of your choice. The maximum is $100,000, and it is offset. It's an offset for your RMD. So let's say your required minimum distribution is $25,000. You could take that $25,000 out, meet the IRS requirements. You have met your required minimum distribution, and then give that money to charity. It's a little bit of a paperwork shuffle, but give that money to charity, and you would avoid taxes on the $25,000. Of course, from a planning perspective, you need to have charitable intentions. Otherwise, this strategy doesn't work. But what Dave and I would not want our clients to do is take that $25,000 out, pay taxes on it, federal and state, if you're in the state of Connecticut or in a state with a state income tax. But take that money out, pay taxes on it, put it in your checking account, and then write a check to your charity, because by doing it that way, you're paying taxes needlessly. The QCD is a very elegant way to reduce your taxable income, get the money to charity, and still do what the IRS requires in terms of the required minimum distributions. One final note before I kick it back to Dave is that this year, the CARES Act, the same act that Dave spoke about earlier, one of the provisions there in that legislation waived RMDs this year. So there is no requirement to take money out of IRAs in 2020. That will kick in again in 2021, but as we all know, this year is, let's just say, special.
Yeah. And Chris, just to add to that, if they take the RMDs recently, there's a chance they could send it back if they wanted to, correct?
That is correct. Yes, so there's a provision that if you did take your RMD and you were unaware of this provision, you could put the money back into your retirement account, and avoid the taxes and take advantage of the waiving of the RMDs this year.
So some other changes with the CARES Act as it relates to the charitable giving is for those that can't itemize, they simply just don't have enough deductions to hit that high hurdle. One of the things the CARES Act did change is it gave the ability for those people that still want to make a charitable donation to take an above-the-line adjustment for $300, up to $300 as a cash contribution, as opposed to itemizing. This is a standalone line item on your tax return this year. First time they've done this. I kind of like this because I know a lot of nonprofits were hurt. So now people will get some tax benefit. It's not a big one, but at least they can do it. Now they also can, in the past, you were limited to take only up to 60% of your income and donate it to charities. The rest would be carried forward. In 2020, and just in 2020, you have the option to elect 100% of AGI deduction limit for cash donations. And if you did want to make more than that, say you made $50,000, and I'll talk in the next slide, you know, the ability that you want to donate significantly more, maybe a one-time lifetime donation, you could actually deduct more than 100% of your AGI in 2020, and the excess above 100% would be carried forward for up to 5 years. This is another thing that's new this year, and it's a one-time only thing as of right now. So here's another example. Chris talked about donating your RMD to charity. Here's another way to do it. I have another number of clients that do it exactly this way. Chris talked about taking the RMD, paying the tax on that income, and then making a donation to a charitable nonprofit. And versus if you have an appreciated asset, stock, mutual fund, and you don't want to pay the tax on it, you could transfer that asset directly to a nonprofit, a charitable association, and not pay the tax on it and get the deduction. And when you do that, there's a significant tax savings that could be made. So if you look at option 1 year, I'm talking about a stock that you bought, maybe you bought it 20 years ago for $5,000, and today it's worth $50,000, and you'd like to make a donation to your church, your alma mater, anything, right? You could take that $50,000, you could sell the stock, and you could pay 15% tax on the gain, which in this case would be $45,000. $45,000 times 15%, you'd pay $6,750 in tax, leaving you with a little over $43,000 that you could donate to your charity. And that $43,000 would give you a $3,630 tax savings, right? Or you could take option 2, and you could call your broker, whomever you work with, and have them essentially journal the mutual fund, the stock shares, whatever it is, directly to your charity of choice, and you'll get the full donation deduction of $50,000. You won't pay any tax on the transfer, but you'll get the deduction on your tax return, giving you a saving of $12,000. The difference is you'd end up saving saving tax of about $8,370. So it's a big difference, huge. So when we talk about capital gains, we still have 3 rates. What many people don't know is there's a chance that many people won't pay any tax on their capital gains depending on their income. So if you're married filing jointly, you have income up to $80,000, your capital gains tax rate is actually 0%. If you have income up to almost $500,000 as a married couple, your capital gains tax rate, and this relates to just long-term capital gains, is 15%. And if we're lucky enough to make about $500,000 or more as a married couple, you're only paying 20% on that income. So your regular tax bracket will be in the 30-some%, but your capital gains tax rate maximizes at 20%. And this relates to long-term capital gains and qualified dividends.
So Dave, before we flip to the next slide, this is a great planning opportunity here as we come to year end, because there are some people that have had their incomes decline this year. And if that's the case and you're under the $80,000 from married filing jointly, you should work with your financial advisor, look at your investments, because if you're going to come in under $80,000, you can sell investments that you have, harvest the gain, the long-term gain, and pay 0% taxes. So if you're in that situation, you can sell the investments. And you may be wondering, well, what if I don't want to get rid of that investment? Well, you could just buy that investment back, and you would begin your new cost basis at the new purchase price. So this is an unusual year, as I mentioned before. So there are some people that will find themselves at lower incomes than normal. And if that's the case, over the next 30 days, it's a wonderful opportunity to sell some things at capital gain, pay 0% long-term capital gains tax, and then conceivably even buy back the asset, assuming they liked it before. It's just a little bit of a proactive way you could mitigate taxes and avoid taxes that you might have to pay in the future. This strategy works generally. If we're working with a client and we know that they're unemployed or their small business is struggling in a year, we want to look to see if we could take advantage of the 0% capital gains tax rate. It's a really underutilized strategy, but when it works, it comes in really handy.
So here comes my dog to say hello to everybody. So this brings us into exactly what Chris was just talking about, some tax gains and loss harvesting. What that means exactly is looking at where you are and making the appropriate changes before year end, because once we flip the calendar to 2021, it starts all over again. So if your income is lower this year, or even if it's higher, you may want to make some changes. Maybe you have some gains in there, but you may have some losses that you could use to offset them and potentially reset the bar on any of the assets that you have that Chris was just talking about, that potentially you want to sell and rebuy or redeploy into something new going forward. So it's a great way to talk. I have 2 of these meetings set up for tomorrow with clients to do exactly this, to talk about capital gains tax strategy. So one of the things that to think about is it's been a very strange year, and for those that were investing after the market crashed when the pandemic hit early in March, have done very, very well, but they may also have some losers still in their portfolio. So if you were to take some of those losers and offset all of your gains, you still get up to a $3,000 loss above your gains if you had those losses. So in other words, if you had $10,000 in gains, but you had $15,000 in losses, the $15,000 in losses will offset your gains, but you'd also get a $3,000 loss that will offset any other ordinary income, and $2,000 would carry forward into a future year. Another thing to think about in terms of tax planning before the end of the year.
So one thing, and you could see there at the bottom of the slide, is there is something to be careful about with this strategy, and it's something that Dave and I are hyper aware of when working with clients, is there is something called the wash sale rule. And I think, in my experience, this is kind of misunderstood in the marketplace, because if you sell something at a loss, the IRS does not want you to buy it back within 30 days. So if you sold, say, Boeing, just as an example, at a loss, and you wanted to buy back Boeing, you'd have to wait 30 days. If you bought Boeing back within the 30 days, would be a wash sale, meaning you could not take the loss on your tax return. So hopefully that makes sense. Where there is some confusion is that if you sell something for a gain, like in my example, where you're trying to take advantage of the 0% long-term capital gains rate. If you sell something for a gain, this is where the confusion comes in. If you sell something for a gain, there is no 30-day wait. You could sell something for a gain, book that gain, and buy back the asset, the investment, the same day even. It's not subject to the wash sale rules of the 30-day waiting period because you're booking a gain. There's a difference between booking the gain and booking the loss. Did I explain that okay, Dave?
Yeah, that's perfect. And the thing to think about that, and we'll talk about this in a few slides from now, is there's a potential change in the capital gains tax rate with President-elect Biden's proposed tax changes. We'll talk about that in a little bit. But we'll get back to your point, Chris, when we talk about that, okay? So when you do harvest capital losses, you should always think about looking, to Chris's point, if you have any gains and you've taken the losses, now's a nice time to take those gains, offset the losses, and essentially reset the clock on the same asset. So if you actually were lucky enough to buy Boeing a few months ago and you wanted to sell it and reset your clock, you could do that today if you have a gain on it, or if you have any other stock that's sitting there with a gain, you could use that, sell it today, offset your losses, not pay any tax on the combined net zero between the losses offsetting the gains, and reset your price on the stock that you sold at a gain.
So before we flip the slide, it seems to me, and Dave, I think you agree, is this has always been an important strategy, but in 2020 it's important because there's a lot of crazy volatility in the markets. So you might have losses, you might have gains, you might have more trading than you usually do. I think additionally, it's my opinion that tax rates are low now. Tax brackets are wide now. It may not always be the case. So anything you can do today to mitigate your tax liability in the future, that's always worthwhile, but I think it takes on even greater importance if you think about the sunset after December 31st, 2025, and if you contemplate potential changes in the tax code before then, given the results of the presidential election.
Right. So, and here's one of them. So President-elect Biden has talked about eliminating the preferential rate for long-term capital gains and qualified dividends on income over $1 million. Now, if we get there, that's I looked this up. It's much less than 1% of taxpayers. But if you're lucky enough to be in that group of people, this could be significant. You're investing some money. You have a $100,000 gain, and instead of paying 20% in those, you end up paying 39.6% or more, maybe upwards of 50%, depending on what state that you're in. So the thought about taking advantage of what the rates are now is something that's pretty significant for some individuals. So we're going to talk about some retirement contribution planning as it relates to 2020 and a bunch of different options. So Chris is going to talk about what your options are.
What we wanted to do was just quickly run through with you the retirement contribution plan limits. And some of you may be familiar with these. Some of these retirement vehicles may be a little unfamiliar. But just real quickly, the maximum contribution for traditional IRAs and Roth IRAs is $6,000. There's a catch-up provision, so if you're over the age of 50, you could put in an additional $1,000 for a total contribution maximum of $7,000. For employees contributing to a 401k, the employee elective deferral maximum is $19,500. Here again, there's a catch-up provision, so if you're over the age of 50, you can contribute $6,500 on top of the $19,500 for a total of $26,000. For simple IRAs, which is a retirement vehicle for small businesses, the maximum contribution is $13,500 with a $3,000 catch-up for those over age 50. For those contributing to a SEP, the percentage match limit is 25%. And for self-employed, it's 20%. And in terms of defined contribution plans, which is it's sort of the same as a 401k, but it's a little different. It's kind of a technical term. But the most you could get into 401k is $57,000 from all sources. So when I say all sources, you may work for a company where you could put money in out of your own pocket, the elective deferral I mentioned a moment ago, but the company may be contributing also. And there's various ways a company can contribute. It could be a match, it could be a safe harbor contribution, it could be a profit sharing plan contribution, but the total amount of all sources cannot be greater than $57,000.
So Chris, can we just go back to that slide for just a second? So just one of the things that I wanted to mention is a 401k. Some of you may have a 403b, which is a nonprofit version of a 401k. So those limits are the same as a 401k at $19,500 and $6,500. And for tax planning, you may be able to put some money into a simple or a 401k as well as an IRA or a STEP. It depends on what your personal tax situation is. So, we could talk about that and see what your options can be or will be.
So one thing that Dave and I wanted to share with everyone is traditional IRA versus Roth IRA and the decision to convert to a Roth IRA. With the passage of the Secure Act back in December of 2019, which, by the way, seems like so long ago, but it really was less than a year ago, there was some changes to the options a non-spouse beneficiary has if they inherit retirement account money from a different generation. And with this tax bracket and tax rate attractive feature we talked about already, there's a lot of reasons to consider converting to a Roth IRA. Now, it's not for everyone, but it's definitely something that for the clients that we have here at Elliott Wealth Management Services, providing comprehensive financial planning, in each and every instance, we want to take a look to determine the right amount of money, if any, that should be converted to a Roth IRA. And there's a lot that goes into this, but as an example, we talked about some individuals this year might have lower income than they did in the past. And if that's the case, you may want to convert money to a Roth IRA this year to fill up some of those lower income tax brackets we shared a few slides ago. Because if you think about it, if I could convert money to a Roth IRA and, let's say, as an example, pay 10%, which is the lowest tax bracket, but humor me on the illustration. Well, if I can convert money to a Roth IRA and pay 10% because I expect for any number of factors in the future I will be in a higher tax bracket, I'll gladly pay the 10% today in exchange for saving money in the future at a higher tax bracket. So between the pandemic, between changes in the inheritance options of retirement accounts, and because of the favorable tax bracket, tax rate situation, considering Roth IRA conversions makes sense each and every year to figure out if you should be doing any conversions and how much you should be doing. Dave and I are working with a client of mine that I introduced to Dave, and he just retired, and the next couple of years he's going to not be generating much income. He's going to be supplementing his income using some savings he has. So Dave and I are going to work with Tom the next couple of years because he's going to be in a very low income tax bracket, but he's not always going to be in the lowest income tax brackets like he's going to be the next couple of years. And Dave and I are working with him to project out taxes to figure out how much Tom should convert the next few years while he's in this very low tax bracket before his retirement income strategy changes and he ends up in a higher tax bracket. Anything you want to add to that, Dave?
Yeah, Yeah, just to add to that, I've talked to a couple clients this year. They separated from their job, so they decided to go out and do something on their own. And generally, what happens with the new business, their income isn't going to be that great as they ramp up, as they gain clients, as they gain business. So their income this is another reason their income won't be as high this year as it will be in future years. And this is another thing that we've talked about is maybe it's the time to take that 401k that you had, put it into an IRA and convert a portion of it to a Roth IRA, because you have 1 or 2 years, similar to Chris's client Tom, that we could take advantage of the lower brackets that they'll be in over the next couple of years.
So you wanted to talk about the Connecticut state income tax deduction?
Yeah. So one of the things that a lot of people aren't aware of is if you live in the state of Connecticut, and many states for that have this law as the state of Connecticut. In the state of Connecticut, if you invest up to $10,000 for a married couple, $5,000 for single or head of household, you could get a Connecticut tax deduction for your contribution made for anybody into a 529 college savings plan. In Connecticut, it has to be in the CHET. In whatever state it is, it has to be in that state's 529 plan to get the deduction. I know New York has a similar deduction, Maryland has a similar deduction, and the other states do as well. So if you have kids, grandkids, you have neighbor's kid that you really like, and you wanted to make a contribution into a 529 plan, if you're living in a state that has the deduction, you may be able to get a state tax deduction, not a federal, but a state tax deduction for the amount that you contribute. And beneficially, in the state of Connecticut, you could actually make, if you have kids or grandkids and you wanted to put $50,000 into their 529 plan this year, you would get a $10,000 deduction as a married couple, and the rest of it would carry forward until you actually use it. So you would get $10,000 a year deduction for the next 4 years after this year. So many people aren't aware of that. It's just a way to benefit your kids and your grandkids, or anybody for that matter, yourself. So other things to think about. We talked about that President-elect Biden has talked about some tax changes during his campaign. Here's a few of them. With the 2018 Tax Cuts and Jobs Act that changed all the tax brackets, it also changed the corporate tax rate. It was a graduated rate that maxed out at 35%. Now it's a flat 21%. That was done so we are more competitive with other countries around the world. Biden has talked about increasing the corporate tax rate from 21 to 28%. He's also talked about going back to the maximum tax rate from 37% where it is now till 2025 to 39.6% for the highest earners, and those would be the earners in excess of $1 million. So, and I put 39.6+%, and the reason for that is as your income increases, the likelihood that some of your deductions that you get, they phase out and go away. So in essence, you could end up paying 42 or 43% on your income, not just the 39.6. We talked about this earlier. Eliminate the capital gains favorable tax rate on people earning more than $1 million from a maximum of 20% to 39.6+%, and also limiting your itemized deductions to 28% of your total income. Now, some of the stuff that we talked about with charitable donations a little earlier, you could deduct this year up to $100,000 of your adjusted gross income to charities this year or more. So one of the things he's talked about is limiting deductions. So if you made $100,000 and you had $50,000 of itemized deductions, including charitable donations and such, you'd be limited to $28,000 in itemized deductions. So it's something that's been talked about. Another big one that with part of the 2018 tax law changes, small businesses get up to a 20% income deduction on page 1 of their tax return to reduce their taxable income. He's talked about phasing out those deductions for those earning over $400,000. Right now, that works if the income related to the business is over $400,000. He's saying it's $400,000 regardless of where the income is. So if you have a spouse that's a high earner, that, you know, a lawyer, doctor, physician, any kind of professional, you could be have a successful business, you'd be limited, and it may be phased out, and you could eliminate that small business income deduction. Eliminate step up in basis. Go ahead, Chris.
No, I was just going to say, I know this is not meant to be a political commentary webinar, but I find this provision, you know, very troubling. This would create a lot of unintended consequences, it seems to me, when you're going to look at a business but treat it tax-wise based on what's going on in the entire household. That I really hope not to see this. I don't know what your opinion is. We haven't talked about it, but
I feel the exact same way, because what's going to happen is in many businesses, what happens is, for whatever reason, 1 year has abnormally high income, and it's not planned for by the business. Just so happens they get a really big job. Something big comes in at the beginning of the year and then at the end of the year, and all of a sudden they'd be losing a very large deduction that's above the line for a single or a household. So yeah, I agree with you 100%. Another potential big one, but I don't think it's going to affect as many. Well, the next one is eliminate step up in basis. This could be potentially huge, because what this means is, if, say, my mom or dad passed away and I inherited some stocks, mutual funds, an asset, when somebody passes away, and say they bought a house for $10,000 40 years ago, and now that house is worth $350,000. When mom or dad passes away and you inherit that, you get a step up in basis to the value of that asset as of the date of death. They're talking about eliminating that step up in basis. So essentially what would happen is $340,000, using my example, paid $10,000, value at the date of death is $350,000. No taxes are paid on that gain, because you have an estate tax deduction that allows you not to pay tax. Right now it's a little over $11 million. So most people are not going to pay any estate taxes or any taxes when they inherit anything, whether it's stocks, houses, or cars, what have you. They're talking about the eliminating step up in basis. This could potentially be huge. And then finally, one of the things I just mentioned, the estate tax deduction right now, where you would not pay any taxes on estate, is a little over $11 million. Talking about bringing it back to where it was a couple years ago, closer to $3.5 million. You have anything to add, Chris?
No, it'll be very interesting to see how this plays out. Just from the political realm, it's unclear as to which party is going to have control of the Senate pending 2 runoff elections in Georgia. And if the Democrats win those races and have control of both the House and the Senate, in addition to President Biden being sworn in January, a lot of these things will be quite likely. Maybe not all of them, but a lot of them will be quite likely. Whereas if the Republicans maintain control of the Senate, I think many of these are unlikely to pass, although I wouldn't rule out some bipartisan, believe it or not, bipartisan wrangling where President Biden, you know, gets maybe some of the things he wants in some type of agreement. But that makes the Georgia Senate races in January very, very important.
Yeah, that's going to be very, very interesting. So just in summary, we talked about a lot of different things. Some of them being looking at your brackets. We talked about taking in some of your retirement and converting that to Roth to take advantage of lower tax brackets in a year when your income is lower. itemizing, taking your itemized deductions and timing them. I talked about a charitable donation. Instead of making the same deduction or donation 3 years in a row, time it, make it all in 1 year, and then 2 years take the standard deduction. We talked about gain and loss harvesting, looking at where you are now before the end of the year and thinking about what we want to reset the clock with. Maybe you have a capital loss carry forward that you want to use, but you have some gains. You should really look at your portfolio and make those decisions now. Chris talked about some things that we could do with regards to retirement planning. Some of those you have the ability to set them up and make the contributions after year end. Some of those have to be set up before year end, so you should really talk to somebody like Chris or myself, and we could talk about what your ideas are. Education planning, we talked about the 529 plan. Charitable planning, pay it 1 year versus over the next 3. Some estate tax planning, we didn't really go over that much, but there are some things to think about. And then just looking at some of your big decisions that you have to make year in and year out, when to make them, what makes the most sense. And then if there's anything else, planning for any other big things. So, like I said, I try and be proactive with my clients as opposed to reactive. I'd rather be able to make decisions in real time as opposed to look backwards and say, I wish we had, right? So help us help you and help us help others. If you know anybody that would like to talk to myself and or Chris, please pass this on. We're going to post this on my website pretty soon over the next couple of days. And if you know of anybody that you think would like to talk to us, I'd love to have their name and give them a call. But in the end, thank you very much. Your health and well-being is the highest priority. We appreciate your time on this Tuesday night and learning a little bit about what we can do before year end. Do you have anything to say in closing, Chris?
No, I hope everybody stays safe and healthy during these crazy times. I appreciate our business relationship, Dave, and I think given what we talked about, given this year, being proactive, being purposeful, and paying attention to planning opportunities on the tax side is as important as ever. And in lots of instances, there's opportunities that have opened up that were not there before, as well as pitfalls that you need to be conscious of so you don't make any missteps. And so individuals should certainly reach out to you, their CPA, their trusted advisor, and when it makes sense, working with a certified financial planner to help with the intersection of tax planning and financial and wealth building planning makes an awful lot of sense. I know it's been a tough year for a lot of people, and many of us are just anxious to see this year turn the page. But over the next 30 days, there's opportunities to maybe make some good decisions. So if Dave can help you, he wants to, and if I could help be a resource, I'm happy to step in and assist as well. So I appreciate everybody listening in today. It's a great group. We haven't had many questions, Dave, so that means either you're just so dynamic and dazzling that you answered everybody's questions before they asked them, or maybe they are watching something on Netflix while they're listening to us. But we want to be respectful for everybody's time, so if you want to throw a question in the chat, please do so. Otherwise, you know how to reach Dave. Call him, shoot him an email. He'll be as responsive as ever, and we could cover your questions individually if you want to reach out. Does that sound all right, Dave?
That's great. Thanks so much for your time, Chris. I appreciate you taking part tonight. And like you said, there's been a number of changes in 2020, and I, like Chris, really wish that the page will change and we look for a brighter future in 2021. I think everybody agrees with that. But have a great night, everybody.